Stock and bond market activity has been materially shaken as Silicon Valley Bank, the California bank subsidiary of SVB Financial Group, and Signature Bank of New York fell into FDIC receivership. In this latest edition of LPL Street View, we'll give you our take on these developments and provide you some suggestions as to what to do about it. Silicon Valley Bank is the first FDIC-insured institution to fail since 2020, and the largest by assets since Washington Mutual failed in 2008. It was the fourth largest banking institution by assets in the U.S. Signature Bank, an FDIC-insured New York State commercial bank, was the 21st largest banking institution. The news of both of these bank failures has caused market participants to speculate if another shoe will in fact drop. At this time, we do not believe the Silicon Valley Bank and Signature Bank of New York failures are deeper signs of things to come. However, we are paying close attention to ongoing developments in the banking sector and in other industries for hints of any widespread contagion. Indeed, we believe more banks may come under distress. As a matter of fact, 72 FDIC-insured banks have failed over the last 10 years. But we are not expecting this to be one of the first of many steps on the way to a systemic crisis. LPL Research's analysis of banks and savings and loan institutions in the Russell 3000 Index points to unique operating aspects of Silicon Valley Bank and Signature Bank that we believe contributed to their downfall. Unlike these banks, we believe many other banks in the sector operate with more operating and balance sheet flexibility that help better manage risk in their business. This is a key reason why we do not believe this will be a widespread issue. The U.S. Treasury Department, the Federal Reserve, and the Federal Deposit Insurance Corporation indicates that all depositors of Silicon Valley Bank and Signature Bank will be made whole. And the Federal Reserve also launched a new funding facility to support the banking sector. LPL's view of the markets and economy is guided by our Strategic and Tactical Asset Allocation Committee and the senior research members within the committee. This committee meets weekly to analyze and discuss capital market conditions and to adjust our market views accordingly. The committee believes investors should react to the Silicon Valley Bank and Signature Bank developments with some caution, as sentiment around bank conditions remains decidedly fragile and depositors in other banking institutions could react irrationally to these recent failures. We believe tactical investors should be maintaining their multi-asset allocations at or near benchmark levels. For longer-term strategic investors, we believe no changes to well-balanced allocations need to be made. Importantly, we do believe overall conditions should improve based on the regulator backstops that we mentioned, but the recent damage to sentiment should be respected, at least for now. Thanks for listening. As we always say at LPL Research, allocate wisely.